A lot of business owners, whenever doing any forecasting, they tend to focus almost solely on the profit and loss statement.
And a special thank you to our sponsor for this episode, Oswego Private Wealth Management. Welcome to another $4 million strategy, the best 4 minutes of business for practical tips and strategies you can apply to your business today. Got a little shout out to Pi Kappa Phi, my fraternity, Alpha Delta, 100 years old. I got my mug up today. So anyways, a little shout out to Alpha Delta at the University of Washington. All right, moving on. We've got Sean Healy with us. He is the CEO of Accounted For. Our discussion today is creating a financial forecast. Sean, how can we do this better?
So one of the things that we tend to find is that a lot of business owners, whenever doing any forecasting, they tend to focus almost solely on the profit and loss statement, right? So they tend to focus solely on how do we project our income? How do we project our expenses? But one of the problems is your income minus your expenses equals profit, right? And accounting firms and accounting professionals, that's their language, right? Profit is an accounting terminology. Whereas if you look at financial professionals, they think in terms of EBITDA. But end of the day, your typical business owner, the language that they speak is cash flow. All right. That's why a lot of times you'll see them staring at the bank account and trying to figure out where's my money going. So the interesting thing is where most professionals are focusing on the P&L and talking about profit, the business owner is thinking in terms of cash flow, meaning that there's a gap. Just because you are spending your money on something does not actually make it an expense. It doesn't actually make it something that lands on the P&L. So this gap is something that we've heard just time and time again of I'm making all this profit, but where's my money going? Making all this profit, but I'm struggling to make payroll. I'm making all this profit, but I'm going into debt. So whenever we build forecasts, what I recommend is you want to be able to budget for non-P&L line items as well. So the biggest four, the easiest four to start a budget for is number one, taxes. So if you are a small business and you are a pass-through entity, usually an LLC, an S-corp, partnership, sole proprietor, something along those lines, the tax expense is actually your expense, not the business's. So one of the things we recommend is start saving each and every month for that taxable expense. Save a percentage of your profits, put it away into an account. If you can budget for that each and every month, you won't get hit every March, April with a huge expense that you can't afford. You want to turn it into a Comcast bill almost. Then after that, all your debt payments. So if you have a loan payment, that comes after profit. So what we want to do is we want to be able to budget for all those debt payments. Same thing, just like it's another Comcast bill. If you already have a bunch of debt, so if you have a line of credit, a big balance on it, or a big credit card that you want to pay off, figure out a small chunk that you want to pay off each and every week, each and every month, forecast it. You want to be able to budget that amount. Same thing, it's just another Comcast bill. Then there's owner compensation. So if you're not paying yourself through payroll and you're taking draws, you need to be able to create some type of set frequency that you are paying yourself for an amount that you can project out in the future. And finally, savings. Don't ever discount savings. Every company should have at least one payroll put away, because what is every business owner's biggest fear? And that is missing payroll. You want to be able to chunk these into either set weekly or monthly amounts, just like every other expense out there. And when you have your profit and you show that projection of projected profit, we want to make sure that all these other things that we are forecasting, we're making enough profit to be able to pay for each of these every line items. And if you can do that, that means you have a cash flow positive business model, which is a great first start.
Sean, thank you so much for your insights on creating financial forecast.
Thank you.
And to our listening, thank you so much for your support. I encourage you to subscribe and share with a friend. Thank you so much and have a great day.